An ETF or an exchange-traded fund is exactly as the name implies. Funds that trade on exchanges, generally tracking a specific index. When you invest in an ETF, you get a bundle of assets you can buy and sell during market hours, which can potentially lower your risk and exposure while helping to diversify your portfolio. This is why it's been so popular ever since it was launched in 1993. But how does one tread through this? Do hit the like and subscribe button before we move on to the main topic of today's video. A single ETF can hold multiple assets such as stocks, bonds, commodities, and a little bit of everything. ETF is unlike any other. If you buy a stock of Microsoft, you're just going to have a stock of Microsoft, but on the other hand, if you have a single ETF, it can hold up to thousands of different stocks or bonds, anything. Exchange traded simply refers to the fact that this investment is being traded on the stock market, and the word fund is referring to the fact that ETFs are types of investment funds that emphasize that when you look at other investments like stocks, bonds, commodities, none of those are funds. They're just individual investments that trade by themselves on the stock market. So what's the first step before engaging in this world of ETFs? The first thing to do before you proceed with the buying and selling of an ETF is to open up a brokerage account, which is an investment account that allows you to buy and sell a variety of investments, such as stocks, bonds, mutual funds, and ETFs. Whether you're setting aside money for the future or saving up for a big purchase, you can use your funds whenever and however you want. You can choose from brokers like Vanguard, Charles Schwab, E-Trade, and M1 Finance. Okay, so now you've got your eyes set on your broker of choice. After that is choosing the account type that you will open within the broker. If you're only planning to do some general investing for sustainable income, or you're planning to build your own dream house in the next 3 to 5 years to come, then opening a standard individual investment account is the one you should choose. And if you're going to open a retirement account, there are also a lot of brokers that specialize in that area. Now that you've established which brokerage you want to start with, it's now time to focus on what ETFs you want to invest in. And you have a wide array of ETFs to choose from, as there are currently 2,700 ETFs being traded in the market today. You can be easily overwhelmed with such a huge number, which is why to truly set your goals straight, narrow down the 2,700 into 3 that are going to fit your exact investing style and your objectives. Let's say that you're investing long-term for retirement. You should then choose ETFs that are going to give you aggressive growth along with dividends. And if you're already approaching retirement, investing in less aggressive ETFs is recommended. But how does one truly find the perfect ETF for you to invest in? Before I answer that, do hit the like and subscribe button. There are a lot of different ways on how to find the right and best ETFs to invest in. And the most fit to do this job is this very powerful tool, which is a website called the ETF database. This website finds and sorts through different ETFs in vast categories and market sectors. Endless amounts of ETFs of different types to choose from. You can select by asset, sector, industry, religion, and even country. It just goes on and on. You can also search by popularity and largest dividend payout. Once you've picked out which kind of ETF you want to invest in, you must further analyze them. Look further into them to get more details, such as how much stock is this ETF currently holding, how much return does it give off every year, and does it pay dividends? To find an answer to these questions, go to an ETF's profile. This is done by just simply searching the ETF name on Google, and the first organic link that pops up is the ETF profile. Once you enter the profile, you're going to be welcomed by a lot of details about the said ETF, some of which are not even relevant. So to not be thrown off by the stream of information, you can directly look at the product summary instead, where you'll be able to see the main information and its goal, and see if it aligns with yours. After that, look for the expense ratio. How much is this ETF going to cost you? Think of the expense ratio as the management fee. Always pay attention to the expense ratio, as it can really eat into your profit once you choose an ETF with a high IR. The next important place to look at is going to be the performance of the ETF. Look for the price and performance tab. If you're already planning on a long-term investment, make sure that the performance history of the said ETF has been considerably doing well for the past few years and for the next years to come. Focus more on the since inception return and the 10-year basis. Don't base your decision on the 1-year return, even if it has a high of 28%, because this doesn't mean that even though it has given you a 28% return this year, it's going to give you the same value over the next 10 years. Another factor you should look into in the ETF profile is the market sector sections and the largest holdings. The market sector will show you which sectors this ETF is investing in. In an ETF like VU, the information technology sector makes up 30% of this ETF. The final destination when looking at an ETF profile is the distributions, which are the actual dividend payments that you as an investor receive for owning shares of that specific ETF. And those are the important points on how to analyze an ETF. If you learned a lot by watching this video, hit the like and subscribe button. Now that you know how to analyze an ETF, how can you avoid a dilemma known as fund overlap? Fund overlap is when two or more ETFs in your portfolio are investing in the same stocks within the same sector. This could pose a problem because it will be a hindrance to what we call diversification, which is what investors do to spread out their profits by mixing in a variety of investments within a portfolio. Why invest your all into Apple when you can invest in VU, which is an ETF that invests in the entire SP 500 index? And if you don't know the SP 500 yet, it is a stock market index tracking the performance of 500 large companies listed on stock exchanges in the United States. It's actually one of the most commonly followed equity indices and one where Apple is a part of. If you solely invest your entire fortune in Apple, then the growth of your portfolio is entirely dependent on the growth of Apple. Although this doesn't seem like a problem right now, since Apple is continuing its rise in the stock market, one can never know for sure how that's going to change in a few years. To prevent this fund overlap from happening, you can use a fund overlap tool which can show you how much overlap is going on between the ETFs that you're investing in. Alright, now that we've tackled that, let's proceed to portfolio correlation. Correlation in itself basically measures the movement of securities such as stocks, bonds, and ETFs in relation to each other. The correlation coefficient, on the other hand, is a formula that measures stocks, bonds, ETFs, and other investments. So when securities typically move in the same direction, they're considered correlated and will fall between 0 and +1. On the other hand, if securities move opposite of one another, they have what we call a negative correlation, which falls between 0 and -1. If you want to promote diversification in your portfolio, you must not only invest in a broad selection of various stocks with the use of ETFs, but also explore a selection of stocks and other assets that are not in close relation to the other, such as real estate and stocks. What stocks interest you for a more diversified portfolio? Write down in the comment section below, and also don't forget to hit the like and subscribe button. If your main objective is to invest for growth or dividends, then you should invest in ETFs that will give you growth or dividend or both. But if you want to limit your portfolio to a certain area, investing in businesses that have low correlation and adding them up to your portfolio will help balance everything out. So now that we've settled that, how much money does one need to invest in an ETF? These days, it's so easy to begin your journey through this investing technique because brokers are offering fractional share investing, which means that anybody can start investing in ETFs with as little as $1. But a piece of advice, you must invest in money as much as possible and constantly add cash into your brokerage account every single month and year. Take advantage of the compound growth in the stock market and continue to build your wealth. Others may say otherwise, but let your experience teach you how it's done. This is me signing out, and once again, don't forget to hit the like and subscribe button as you go. See you!